Good morning, everyone, and welcome to the 27th episode of the Capitally Insight series. It has been our privilege and pleasure in bringing to you a variety of domain experts since we first began the series in January 2021. The topic for today's discussion is navigating market volatility. Volatility is how much and how quickly prices move over a span of time. In the stock market, increased volatility is often a sign of fear and uncertainty among investors. And this fear gauge has been unprecedentedly high as we have had two major back-to-back global events. First, a once-in-a-century kind of pandemic, and then the Russia-Ukraine war. The first event resulted in the global central banks printing money at a record sum and speed and putting it into the pockets of people and organizations. This created a demand for goods and services over the last 3 years. On the other hand, both events resulted in unparalleled tightening and disruption of supply chains since we came to embrace globalization in the modern world. And as we all know, high demand and low supply of goods or services result in high prices or high inflation. Now, Act 2 for the central banks for the last 10 months has been sucking out excess liquidity, increasing interest rates, and effectively puncturing the bubble they created in the first place. This has led to wide gyrations in stock markets as global interest rates multiplied from near zero to 4 to 5% levels, last seen in 2008. It is also seen that steep interest rate hikes lead to financial distress in economies. We recently saw the failure of Silicon Valley Bank in the US, and the SVB saga and the Fed's response to it shall have some impact on financial markets, the banking system, the pricing of risk and loans, and of course, the future Fed policy. But the heightened risk to the global financial system due to the fastest interest rate hikes in 40 years needs to be balanced against stubborn inflation led by continuing wage growth and the lowest ever unemployment in the US. So is the failure of SVB a sign of systemic contagion in global banking? And how should one navigate the market volatility and the price correction, especially on the back of an 18-month-long time correction in the Indian markets? It is said that short-term volatility is highest when we are near turning points, and it reduces as a trend becomes established. So what lies ahead? Let's hear it from Roshi Jain, Senior Fund Manager Equity at HDFC Mutual Fund. Roshi is an experienced and one of the top performing fund managers in the country, having spent 17 years managing equity funds at HDFC and Franklin Templeton and researching equities at Goldman Sachs in London, Singapore, and Hong Kong. Needless to say, she's a rare breed of women fund managers, one of a very few. And funds managed by her and she herself have won several awards for top-notch performance. Roshi, we are absolutely delighted to have you with us today. Welcome.
Thank you, Rajul. It's indeed a pleasure to be here to address all of you.
Of course. So before we move, I hand it over to you. I would like to mention for our audience that we shall have a question and answer session at the end and request you all to please address your questions to the panelists. Thank you. So over to you, Roshi.
Sure. So I think Rajul set the context very nicely, putting across the macro events that the global economy is sort of facing, which has brought about increased volatility. But I think it would be helpful for us to take a step back to understand what the India story is all about, because I think sometimes just getting a refresher on what is it that India stands for in the longer term perhaps helps to ease some of the uncertainty as well as the volatility and the fear associated. So what I will do is run you through in an unbiased manner, I hope, both the pluses and the threats that the Indian economy faces. And then we will address some of the shorter term issues and challenges. I'm going to share my screen.
Sure.
So just give me a second.
Yes, it's visible.
Okay. So this is a chart which genuinely reflects longer term. This takes us back in history over the last 4 decades. And what we have done is categorized these periods into groups of a decade each. The idea being to show that each decade has events that seemed unprecedented, as perhaps the current scenario does. We've had a series of not just domestic, but even global events. And you will see the dark blue sections of the tables showing you the kind of real GDP growth that the country has managed to sustain. So despite the events that we have seen, such as, let's say, the dot-com crisis, the Gulf War in the 90s, the GFC in the decade of the 2000 to 2010, and more recently, the Russia-Ukraine war, the interest. You will see that the Indian economy has been fairly resilient, recording about 6% kind of real GDP growth over the last 4 decades. I think what makes it even more commendable is the fact that this growth rate has sustained even as the economy has grown in size. So generally, one tends to associate growing size with lower growth rate, but I think the fact that we managed to sustain the 6% kind of growth at much higher levels of GDP perhaps stands testament to the inherent resilience of the economy. Now, what is it that we believe will help India sustain the 6% kind of growth over the next decade? The boxes in blue are some of the positives that we think stand India in good stead over the next decade. We will go into some of this in a little bit more of a detail, but just as a snapshot, I think India over the last decade had lost share to manufacturing. Actually, the share loss in manufacturing was something that is now a 2-decade phenomena, especially as we saw China's share of manufacturing in global trade and GDP sort of take a leapfrog jump, especially post China's entry into the WTO. But we believe that we are at that inflection point where India is set to recapture some of that lost share in manufacturing. The last decade also saw a period of repair and restructuring of the Indian economy. I always believe that we should never let a crisis go waste. And I think the period of post-GFC did bring some crisis situations to India because of the large fiscal deficit that we were running. We were also running a large current account deficit. Corporate balance sheets were stretched. The banking system was dealing with NPAs. I think we have used the last decade to sort of deal with some of those problems in the past, which now puts us on a good footing for the next decade. And we've also seen the government's impetus on the infrastructure sector. I think one of the things that has been holding the economy back has obviously been the underinvestment in infrastructure. And as we see that reverse, as we see the government put more thrust on infrastructure, we think that holds good stead for the economy. Housing, again, an underappreciated sector, and I'll talk more about it as we go into detail on the housing sector, but we are starting to see a recovery in the housing sector as well. We'll come to the risk part, which appear a little bit more relevant at this point in time. But I do want to mention that we very thoughtfully put this chart together. There are 7 positives as opposed to 3 negatives. So that's something that I would genuinely like the audience to take away. Yes, there are threats, but in the longer term, I think that the positives in the economy will more than offset some of the shorter term threats that we could be facing. So threat number 1, I think, is our twin deficit. We are a current account deficit country, in addition to, of course, being a fiscal deficit country. So generally, that's something that is a little bit of a weakness for an economy. Globally, inflation continues to persist at high levels, leading to higher interest rates. And valuations not exactly very attractive, and we'll go into detail as we go through the valuation section. So let me start with the positives first. As equity investors, I think we always need to have an optimistic bias, and so therefore let's start with that. The first driver, which I think is really an inflection point in India's manufacturing story, is just the uplift in manufacturing that we see for India as an economy. I think that, over the last decade, we have sort of lost the plot on manufacturing, largely because the infrastructure was a constraint. And second, I think, there was an over-indexation in favor of China by several MNCs. What is happening now is twofold. I think the first and most important is that the COVID crisis has shown MNCs how over-indexed their supply chains were in favor of China. China's COVID story was a little bit counter-cyclical to the rest of the world's COVID story. So when the rest of the world was opening, China was under a lockdown, and clearly that completely messed up supply chains. It was really a surprise even to me to find out that almost 95% of Apple's iPad production was happening out of a single facility in China. Now, that is clearly not good risk management. And I think several MNCs have started to realize that while it may have given them some cost efficiencies, however, in the bigger scheme of things, risk management was a casualty. And we are now starting to see several MNCs wanting to move supply chains out of China. Now, India will be one of the very several beneficiaries. I think there's Vietnam. There are countries in the ASEAN region, nearshoring happening in favor of Mexico and that region. But I think India will also be one of the beneficiaries for the reason that the government is also now realizing how important manufacturing is for job creation. And so I think it's a very nice coming together of the need for MNCs to diversify, and governments now putting their best foot forward to attract some of these companies to India. Apple is a very well-known story, but the PLI scheme in general ties in very well with the MNCs moving out of China. I think it's an opportune time as well for the PLI scheme to have been launched. To my mind, that is a scheme that will ensure that a lot of MNCs look at India seriously as a manufacturing destination. The second point is, if you look at the table in the middle, which shows manufacturing wages, I think in our minds, we continue to still think that China is a cheap manufacturing location. However, no longer so. China has seen significant wage inflation. As you will see, India is now half the labor cost of China. And even if you adjust for productivity differentials, I think that the cost proposition just becomes extremely attractive for India.
How is Vietnam on that front, Roshi?
Vietnam is as competitive as India. The disadvantage for Vietnam, though, is just the scale. I think the size of the economy, the population, etc., is just a disadvantage, as well as the quality of the labor force, I would say, especially when it comes to higher end
English speaking skilled.
That is correct. If you look at the chart on the right, and this is something again that we tend to dismiss, but China is now facing a shrinking population. The working age population anyway peaked a few years earlier, but now even total population is starting to decline, and labor cost is a function of demand supply. So as you have shrinking labor supply, you are starting to see wage costs go up. India still has a full decade advantage in terms of increasing labor supply. So I think this is an important advantage. And not only does this lead to improvement in the manufacturing intensity of the country, but it also helps to kickstart private capex, which is something that over the last decade we've not seen happen. I'm just going to also touch upon the first table, rather the first chart here, just to show the disparity, right? So China is 15% of global merchandise exports, India just about 2%. So even if China loses just 10% of
16
exports in favor of India, we double. Now, I'm not saying that will happen overnight, but I'm just telling you the potential that there is for India to move up on that scale. Let's move towards private capex now. So I talked about how manufacturing and the resurgence in manufacturing could kickstart the private capex cycle. If you look at the chart on the first chart on the left, you will see that the capex intensity of the private sector has come off significantly, and it's sometimes base effect helps, and I think to that extent the base is now so benign that there is no other way for us but to go up. And I think that the kickstart will come from higher capacity utilization in the economy. So you need to start putting new capacities, manufacturing I talked about. And also, one is, of course, the need for capex. The second is the ability of companies to do capex. And in that context, if you look at the right-hand slide, you will see that Indian corporates have really gone through that deleveraging. Post the GFC, there was a little bit of profligacy that had come into the Indian corporates, and we saw leverage levels go up. But I think post the NBFC and banking system NPA crisis, we have seen corporates get extremely disciplined. The last 2 years, the COVID years especially, have sent the message home to corporates that they need to get their balance sheets in ship shape. And you can see that the Indian corporates now have deleveraged, and balance sheets are now quite strong. So I think that the setup is now quite favorable for a pickup in private capex across sectors, not necessarily just heavy industry like metals, etc., but also more lighter industries. And therefore, we should start to see that capex to GDP number move up.
How about demand, Roshi? I mean, are you seeing significant demand pickup? Because that was one of the reasons they were hesitating in putting up capacities.
So, I think some of the capex is now going to be a little bit inelastic to demand. And why do I say that? Because it's not driven only by demand, it's also driven by the need to risk manage or to risk mitigate. If you need to move your supply chains out of China, you don't necessarily need new demand. You just need to reshuffle your supply chain because you think that that is good risk management. So even without increase in aggregate demand, India will still be a beneficiary because of the need for MNCs to get risk mitigated. And therefore, I feel that this time a lot of capex in India will not be as sensitive to global demand, because the driver is not necessarily demand. The driver is more risk mitigation. Let's come to the banking system. A robust banking system is extremely important for the growth of the economy. And I think we've gone through the period of extreme stress. If you look at the chart on the left, you can see that our NPAs peaked. This is net NPAs, right? So after provisioning, peaked at almost 6% of the system loans. So from there on, we've made significant progress in terms of banks cleaning up balance sheets, using, building up provision buffers. System capital adequacy, basically for banks, capital is the raw material basis which lending happens. And you will see that capital adequacy, again, something that the regulator has been tirelessly working on, is also extremely robust.
Yeah.
Credit growth clearly that was something that had sort of stayed weak, especially over the last 2 to 3 years, and we are now starting to see a pickup. Actually, FY23 will be a fairly good year in terms of credit growth. So I think the banking system, and this is a big contrast to, I'm sure we will be talking about it as we talk about SVB and the US and the CSFB and so on and so forth. But this is a big contrast to the banking situation in the rest of the world, where capital adequacy reasonably good, but I think there were a lot of gaps in terms of the way some of the investments were being valued, and therefore capital adequacy looked a lot better than it actually was. I was on a panel recently, and there was one point that I made, which is that India's banking regulatory framework seems to be more first world than how first world countries should be running their banking regulation.
Absolutely.
So it's very ironical, but I think the last decade, the way monetary policy has been run and the way banking regulation has worked, I think clearly we can share lessons with some of the more developed countries, just as how UPI is a platform that we are ready to now offer to the world.
Absolutely. I mean, during global financial crisis also, the developed world said that, oh, we did not have certain things. Now we are reforming. Now we are putting things in place. And it came as a surprise then too, they've been developed countries for so long. Absolutely. And now it happens again in a matter of 15 years. And you say, oh, this time these were not regulated. Now we will, now we are looking into it.
Correct. No, I think this time the emerging market, more specifically India, I think has really managed the banking situation extremely well. Not that we did not have our challenges, as you can see, 2012 to 2018 was an extremely challenging phase, but I think the lessons were really used well in order to create the kind of robust system that we now have.
True.
Housing, a sector that we sort of tend to underappreciate, I think maybe because there are not too many listed players in the public markets, but housing. So when we talk about capital formation in India, there are three parts to that capital formation. One is, of course, government infrastructure, which we all know and talk about. Then there is private capex. The third part, which can actually sometimes be bigger than each of government and private capex, is household capex, and housing is a large part of household capex. Now, we've had a very poor housing cycle now for close to a decade, maybe even slightly more. Generally, this is the sort of time that a cycle takes to play through, and I feel that we are now sort of well poised for that cycle to. It's already recovered. We are past the bottom, but I think we still have a good few years to go in terms of the housing cycle recovery. And why do I say that? If you look at affordability, it's now very attractive because over the last decade, barring the last 5 or 6 months or maybe the last 1 year, prices have gone nowhere, whereas incomes would have more than doubled at that point in time. And therefore, what was unaffordable a decade back now suddenly becomes affordable because prices have stayed the same, whereas incomes have gone up. The other thing which has happened, which is extremely important, is also the regulatory framework. When you decide to invest in a house, it is a large investment and you need to be confident that you will get possession. I mean, most of you are based in the NCR belt, and I'm sure that you've seen a fair share of, disappointments as far as building construction or deliveries, etc. were concerned. But I think what RERA, which is the Real Estate Regulatory Act, has done is that it's now brought some buyer confidence. There is now a framework where projects, there is a time frame given for projects to be completed. Diversion of capital from one project to the other is generally quite tough. So I think that has also led to improvement in buyer confidence as well as consolidation in the sector. So many of the riffraff players have not been able to cope with new regulation, unavailability of financing post the NBFC crisis. And so you've seen that the housing cycle recovery is happening at a time when the sector is also consolidated and only the stronger players are left in the system. So I think that's a good sign as well for sort of continued sustenance of the
some of
housing
the
sector.
Roshi's projects which were in a limbo because of lack of liquidity. So there was this program where liquidity was provided, and this projects have also been completed. I think a large number of projects have come into kind of mainstream now, which was a positive. It sent out a very good signal. And what about this PMS, Prime Minister's Awas Housing Yojana? Because there also there is a lot of infrastructure directed. What part would that be as a percentage of this total housing we're talking about?
So in terms of, so that is something that gets captured. So I think that's something that is not exactly, from at least a housing cycle perspective, not as big of a value driver. It could be a fairly large volume driver. But I think when we talk about housing here, this is more the sort of organized urban sort of housing that we're talking. And urban would,
so that part does not have constitute this part. I mean, that is separate on top of this. Okay.
Because the affordability ratio that we show here is more from those who access bank financing.
Okay.
And therefore, that would be limited more to the sort of urban consumer as opposed to the rural consumer. But no, the Prime Minister Awas Yojana has also been a large driver in terms of the volume recovery. So some of the cement volumes, for example, have been a beneficiary of that program.
Yes, in the secondary and tertiary sectors, it does make a difference. Like this,
That is correct. Let's do a quick check also of how India stands versus other economies, because sometimes, it's not important to be good just on an absolute basis, but also on a relative basis. And I think the story here is very stark. It tells you the growth that India has had without compromising on macroeconomic stability. Now, so of course, India is one of the faster growing countries, should come as no surprise. But if you look at the chart on the right, you will see that India and China were quite similar about 2 decades ago in terms of debt to GDP. And you just look at how the lines have diverged as times have gone by. So we've almost maintained our similar debt to GDP levels, whereas China has more than doubled in terms of debt to GDP. So this is not just absolute debt, it's the ratio. So if it was 150% at the start of the period, it's now closer to 300, which means that the absolute debt level has grown many fold. And that's a problem. That's a problem. Sorry, go ahead, Raju.
And I was saying that's a huge number because their GDP also grew at such a fast rate. I mean, most of the years it was growing double digit. So this is a multi-fold rise in absolute terms, I mean.
Absolutely. And the point is that China is still a developing country, but look at its debt dynamics. It's almost, it mirrors that of an advanced economy at much lower per capita levels of GDP. So clearly that's a problem. And that's the reason why, we've been hearing about talk of China will announce a stimulus, but there is no big bang stimulus for this precise reason, that there is just no capacity for the economy to expand its debt any longer. And therefore, they need to be quite careful about how, they navigate through this period of global slowdown, because while post GFC, they were able to expand balance sheet significantly. And you can see that in December 2008, to December 2012, the red line just inflects upward with a much sharper slope. So that's really been an issue with China, and therefore our view that don't expect China to accelerate its growth. There will be no big bang stimulus because debt is an issue in China, whereas India has been growing without compromising on the balance sheet health. Let me now switch to headwinds, which perhaps are of more interest at this point in time. Let's talk about the twin deficits. Now, the reason the current account deficit becomes important in times like this is that we are a current account deficit country, and that needs to be funded, and that gets funded through capital flows. And that's the importance of FII flows. That's the importance of FDI flows. And in times like this, when volatility is generally higher, and you tend to see FII outflows, the impact on the currency sort of gets magnified because you are dependent on foreign flows to plug your current account deficit. Now, the government, of course, has been trying to ensure that the current account deficit comes off by incentivizing industries for exports, by trying to do import substitution. But these are all long-term programs. And, in the near term, clearly volatility on capital account will have an impact on the country just because we are still not a current account surplus country, unlike many others in the region, which do run fairly large current account surpluses. So this is something that we need to keep in mind, especially in the shorter term when volatility is high. The second, of course, fiscal deficit to GDP, we are quite high there, both on a state plus central level. Now, the good thing is that a large part of the fiscal deficit is domestically funded. Nevertheless, the point that I want to highlight here is that in the event of a global slowdown, the government does not have as much room to support growth because you're already running fairly high fiscal deficit. So if you look at government debt to GDP, that's also something that has inched up. So there's just not as much room now to support or run larger fiscal deficits in the event of slower growth.
Right.
This is a more global picture. I would urge you to look at the second chart, which is the G3 change in balance sheet size. And a lot of the problems that we are facing today will become apparently clear. Now, the last 10 years, we've been running a easy monetary policy, and this is G3, so Europe, Japan, and the US. And if you look at calendar 2020 and 21, that's the extent of monetary easing. When we say monetary easing, quantitative easing, etc., $10 trillion was pumped into the economy to support, the system as they were going through the COVID lockdowns, etc. Now, clearly,
and just to add a Roshi little context here for the audience, India's GDP is like $3.2 trillion. So they created three Indias in a way during this time, right?
That is correct. Absolutely right. And as all of that money supply was getting into the system, chart on the bottom, the amount of negative yielding debt, we had almost $15 trillion of debt, which was yielding negative, not zero, but negative returns. This was a result of the huge money that was pumped into the system. Now, some of that obviously is starting to, or at least was starting to unwind because of the inflationary pressure it was creating. Now, the story of inflation is not only because of supply chain disruption. Yes, one of the reasons is supply chain disruption, but it's also because of the amount of liquidity that was pumped into the system. And as that started to unwind, you're now starting to see accidents like Silicon Valley Bank, perhaps some more that will unravel over time. But it's a consequence of the tightening in the balance sheets, as well as the significant and rapid change in interest rates. As you can see, in a matter of about, about 2 years, less than 2 years, the amount of negative yielding debt has gone from 15 trillion to zero. So you can see that, and this is just negative debt, you can see the amount of repricing that has happened in the system. And clearly somebody had to take the hit. And so we are slowly starting to see, these accidents sort of happen. The fundamental underlying cause is these two charts. And then the outcomes, I think, are what we are now starting to see. Persistent inflation. Now, this is something that, need not necessarily be a short-term phenomenon. Time will tell. But we have underinvested in some of the some assets in the last decade for reasons of ESG, oversupply, and so on and so forth. So if you look at the chart on top, oil and gas, clearly there has been underinvestment post 2012. Labor supply has become an issue in the US. So I think it's possible that inflation can stay higher for longer. That's something that, unlike in the past where inflation was a non-issue, I think inflation may not be such a non-issue as we sort of go ahead over the next decade or so. I don't know decade, but at least the next 3 to 5 years. Let's now quickly come to valuations. How are we doing on time, Raju? Are we okay?
Yeah, we are good. We are at 25 minutes left.
Okay. So let's cover valuations now. I generally don't like to talk about valuations in aggregate because I think that averages hide more than what they reveal. But in the interest of just better communication, because it's not possible to obviously do stock by stock analysis and talk about it. So we are trading at slightly higher than average valuations. I think we've seen some correction in the last couple weeks, couple months perhaps. So the Nifty 50 is now trading at about a 5-6% premium to average valuations. However, chart on the right, the MSCI emerging market, the Nifty premium to the MSCI emerging market, which had gone up to as much as 80%, still at a premium, but after India's correction and China doing well post September last year, some of that premium has started to come off. Nevertheless, we are still trading at a premium to the last 5-year average, the last 10-year average. Versus the emerging markets. And I think it's important also at times to not just look at absolute valuations of India, but also to look at relative valuations, because globally money is fungible, money moves from country to country. So I think it's also good to have the perspective of how we are trading relative to how we are trading relative to the emerging markets. But I must also caution this, that a lot of emerging markets, at least the large ones, especially China, is going through a growth dynamic which is very different from what it went through in the last 10 years. And therefore, the 45% average premium may actually move higher. Time will tell, but we should also keep in mind that while India perhaps will accelerate on growth, China will perhaps see a slower growth dynamic in the next few years, and therefore, that's why my point that it's good to be bottom-up focused.
What about the immediate impact of opening up from zero COVID? Do you see higher growth for earnings growth for companies this year over there?
I think that some of that trade has played out. Like I mentioned, the China's ability to really stimulate growth now is much lower than it was perhaps a decade ago. And the reopening trade was also muted to that extent. See, China did not do the kind of stimulus that the US did, for example. So there was some pent-up demand, but it doesn't seem like it's going to be a big growth accelerant. In fact, I think at the recent convention of the Communist Convention that they have, the annual convention, I think the growth that they projected was about 5.5%. Yes. Which is much lower than their past averages. So I think clearly the growth over the next few years in China is going to be a lot slower, and a lot of the opening up trade, at least a large part of the opening up trade, I think is clearly behind us.
Okay.
Mid cap, small cap will not spend too much time. All I'd say is that on a risk reward basis, larger caps clearly look a lot more sort of
better relative basis, you're saying?
Yeah, on a relative basis, not just, and I don't say it just from a numbers valuation perspective, but I think even from ability to manage, manage volatility, ability to go through business cycles. I think larger caps in times like this generally seem to have a little bit of edge in terms of navigating the cycle.
But just because these companies are small, are they able to show some of them better growth right now on lower basis?
The last year perhaps was, but that was because there was pent-up demand. And that's because many of the smaller cap companies were hit disproportionately during the COVID timeframe. Their ability to manage supply chains during the time that COVID timeframe was a little bit impaired. So the base was very weak, and then you had this pent-up growth, and therefore they sort of outperformed on growth. But but in a more normalized world, when you're seeing the kind of global challenges, it appears to me that many of the larger cap companies will perhaps be able to navigate that
better,
slightly better than the mid and small caps. Of course, I would again caveat this by saying that each company is different, but you know, in the interest of just
there'll be outliers both in large caps and in small.
Absolutely. again, not something that I would bore you with, but to me, it seems that FY24 numbers are still a little bit more optimistic. I'm not sure that we end up with a 15% growth. Perhaps there will be more growth downgrades. So FY23, when we started the year last year, was at about a 15% growth. We will perhaps end up with 10. I think it's likely that the same story will repeat in 24 as well. So let me wind this up, at least my part of the presentation, by giving a quick summary. I think that, one of the things that we must take away is that amid the headwinds that the global economy has gone through, whether it's geopolitical tensions, whether it's supply chain, whether it's inflation, I think it is commendable how resilient the Indian economy has been. And, this should give us a lot of hope and comfort about just the underlying fabric of the country. Normally, in times of crisis, we generally tend to see the rupee overshoot. We tend to see current account deficits go haywire. I think we've not seen any of that. And that is a very, very positive signal. Second, private sector capex, infrastructure spending, as well as housing cycle. I think all three elements of these are going to see some pickup over the next few years. And consumption is anyway a theme that always plays out in India, given the kind of middle class population and the scope for greater penetration. So I think not just consumption, which has been the sole saving grace for India in the last 10 years. I think over the next few years, consumption and infrastructure will both support growth of the economy. A low corporate and household leverage, of course, a very big positive. On the negatives, however, we should be cognizant of the fact that globally things can be a lot slower and inflationary pressures can continue to stay elevated. The kind of inflation these countries have not seen in the last 3 to 4 decades, and therefore the ability to cope with it is going to be something that will be challenging for them. The second thing also is the higher cost of capital. In a world where debt is giving you 1-2%, 5-6% from equities is very good. But in a world where you're now getting 6-7% on debt, the challenge for equities is that much higher. So the bar is higher, and therefore, valuation benchmarks will get reset. In an easing environment, it's like a rising tide lifts all boats, but there is no rising tide now. The tide is actually ebbing, and therefore it's up to us to be disciplined and not be tactical, because I think mistakes will be very hard punished, will be punished hard in this environment, just as how we've seen a couple of bankruptcies in the US. So I think, an easing environment lets you get away with a lot, and the reverse happens in a tightening environment. Let me stop there, Rajul, and I'm happy to go through other aspects that you may like me to.
Okay, so I would let me start with the last thing you said on the, what's happening with the banks there, though some of the smaller ones. But this Silicon Valley Bank particularly, which was focused on the startup world, and India also has one of a large startup ecosystem in our country now. So could we see some fallout from the US in the Indian economy, and is that likely to impact anything in general? I mean, you have your IPO markets and a lot of other things. Do you see any interlinkages there?
There will be huge linkages. I think there's no doubt about it. But we must, there are 2 or 3 issues involved here. The first is, of course, the entire startup ecosystem where, funding is now becoming a constraint. And that's clearly because the cost of capital has gone up. There is no unlimited capital. And that's the reason also why we saw this rush of deposits out of Silicon Valley Bank, which, as we all know, was one of the larger bankers to the startup ecosystem.
Yeah.
Startups in India also going through, I think, the same funding crunch. And therefore, you are hearing them talk about profitability, capital discipline, and so on and so forth. So I think that's a global phenomenon, and India is no different. The difference, I think, is in the health of the banking system, as well as the regulatory framework. Now, Silicon Valley was not a small bank, actually. It was the 16th largest bank in the US. But the Dodd-Frank Act amendment in 2018 exempted some of the smaller banks, relatively smaller banks, and therefore the capital buffer requirement, etc., was eased for them. In India, quite the converse, where actually during the COVID crisis, the RBI was extremely conscious of the fact that the crisis could have ramifications and told all banks to increase their capital buffers. The third is that the kind of interest rate sensitivity that the US saw, India did not see, because we never had that kind of monetary easing in the first place. So in the US, the 10-year went from, what was it, 1.5% to all the way up to
almost
4.
0.5 only. It was just 0.5.
So the 10-year was the 10-year went from about sub 1 to 4% before settling wherever it is at now, 3 point something. But that's the kind of sensitivity. Whereas in India, we did not see that much of a swing, and also the fact that in India, the rules around HTM and valuation of investments, etc., are a little bit more stringent. So I think on various counts, India saw a much tighter regime as compared to the US on the banking side. And we must remember that the SVB crisis was not a credit crisis. It was actually a duration asset liability mismatch crisis. They were actually holding extremely safe securities. What safer than US government debt? But because there was an asset liability mismatch problem, they were forced to liquidate assets at lower prices because of
loss. Because
of deposits being pulled out. And that's the reason why I ended my presentation saying that it's time to be disciplined, not just for us as investors, but for corporates as well, because any mistakes that you may have committed in an easing environment will be severely punished when the tide starts to turn. And thankfully, we did not have as much of an easing environment. And thankfully, the regulators were very hawk-eyed about whatever was happening.
I mean, and that reflected in our inflation numbers also, because we were still, we were at 4.5, went to 6.7. Whereas in the US, from sub 1, they were all sub 2, they would always struggle to take inflation up. They went all the way up to 9. So that was many-fold for them. It was a few percentage points up for us.
Absolutely.
I think that all correlates into that. So now, after what crisis, etc., we have seen and volatility in even equity markets in the last 2 weeks, we saw the Fed policy last week. But right now, there is a divergence between what the Fed is saying it will do and what the financial markets think they will do. So do you agree that Fed may actually not need to raise rates further, and the liquidity and the credit tightening caused by the banking crisis will actually do the job of a few rate hikes, maybe leading to slowdown, recession like you're talking about? And on its own, then, inflation also comes down to Fed's target of 2%.
Yeah, no, I think that perhaps we don't get to that 6%, which at some point in the last few weeks seemed like it could happen in the US.
Terminal rate, yes.
Yeah, I don't think that, I mean, basis what we are seeing today, it doesn't seem like we get to that 6% terminal rate. I think the terminal rate will perhaps be lower, at closer to that 5-ish% ballpark. But I do believe also that some of the inflationary pressures are actually quite entrenched in the system. And therefore, it's quite possible that we plateau out. So, one expectation is that we've now peaked and then we go down in a hurry. My sense is that the fall will be a lot more measured. So we may actually plateau out before we significantly go down on rates.
This you're talking about the interest rates or the inflation?
Both. And they are linked in a way.
And they're linked. I mean, one will follow the other.
Yeah.
And, dollar index has also come down to 102 levels. And in January, at similar levels, when it had come down from 114, we saw FIs coming back to emerging markets. And that point of time, more so in China, as it was both cheap in terms of valuations and also promising growth due to opening up. But in India, they have pulled out, I think, close to 2.5 lakh crores in the last 18 months. So do you see FIs come back to India in the near future, or do you see a risk-off scenario still, leading to tepid flows or even further outflows?
Again, tough to take a call on how FIIs behave, but but it appears to me that we will maybe stay in a risk-off scenario for a couple of quarters. And the reason I say that is because, allocation to emerging markets also requires a little bit of a risk-on appetite. And in times like this, when you're seeing bank failures in the US, when, you've seen European banks go through a little bit of a challenge as well, I'm not sure that that risk appetite is really high. So big money, I must though caveat that I believe that over the next 5 years, India will receive much higher FII flows than they have, in the past. I think India will be will gain a larger share of global capital flows. But given the global risk sentiment, my view is that we may not see a quick flip in the next couple of quarters, just given the volatility and the low risk sentiment.
Understood. So Roshi, coming back to our Indian markets and valuations or performance. So last 15 months, ever since, the Russia-Ukraine war and interest rates started going up, your high quality, high growth, expensive stocks have really suffered in terms of stock market performance, and not just in India, actually all over the world, as interest rates were going up. And value stocks have actually found favor with investors. And so do you see a reversal in the current calendar year, 2023, or that also gets pushed by another 2 quarters?
I always try to think, I always at least try to recommend and try to implement myself a very stock specific approach. And the reason I do that is this. It's quite a revelation. But if you look at calendar 2022, the Nifty in aggregate gave about 4% returns. Very unexciting, right? You don't come to equities for this kind of returns. If you just disaggregate that and remove the outliers, you will find that on average, the best performing names gave an average of about the best name, removing the outliers, gave about a 50% plus return. But on an average, I'd say about 30-35% for the top 4-5 names. And the bottom 4-5 were down about 30%, which tells you that there was almost a 60% gap between the best performing and the worst performing. And that 60% gap relative to the aggregate return of 4% obviously tells you that bottom-up stock picking becomes extremely important. Now, one of the things that we keep hearing is this return of value, and value stocks have done well. Now, that's a consequence of the global cost of capital going up. I think that, I showed you the chart where interest rates were yielding negative returns for almost $15 trillion of assets. Now, when something is yielding negative returns, obviously it tells you that the cost of capital is zero, if not negative. In your discounting models, there's just no cost of capital, and therefore growth is the only thing that matters.
Right.
But if you move to an environment where capital now has a cost associated with it, then you have to start factoring in that cost of capital as well. And then you suddenly start to see that only those companies which have a path to profitability, which have return on capital metrics discipline, the tide turns in favor of those. Now, my sense is that this is an environment which will stay for a few more years, if not more. And I do think that while there can be sector rotations, basis individual stocks, etc., but on aggregate, I would think that the valuation paradigm will now change, and there will be greater focus now on capital efficiency and discipline and return on incremental capital than what we have seen in the past.
Also, I mean, for some of these companies which had stronger brands, etc., as costs were going up, they were able to pass on their price increases. And when, now commodity prices, input costs have somewhat softened, you may see those numbers improving in a big way.
There will be clearly some benefit of commodity costs coming down. But I am not in the camp that believes that commodity costs will fall significantly. because like I showed you one of the charts, we have underinvested in the commodity segment over the last decade. So clearly from the very high rates that we saw last year or early last year, we've seen some correction, there was the war and so on and so forth. But I don't think that we go down a lot, and therefore the space for commodities adding to gross margins, to my mind, is limited.
Got it. So which sectors and themes you think, to your mind, are likely to do well this year?
I think in line with the macro drivers that we discussed for India, I think manufacturing as a theme will come back. I think banking, given its strong balance sheets, should do well. I think infrastructure should do well. Some of the more global facing sectors like metals, etc., could see some challenges, especially as China slows down and we start to see slowdown in the Western world as well. But this is very much of a generalization. I would only advocate a more stock specific approach, because genuinely the world today is throwing up challenges and opportunities which are quite different from what we had seen in the last decade.
So I think being agile is of topmost importance.
Being disciplined.
Yes,
more than being agile, because sometimes when you're agile, you're just doing things without thinking through some
just
of the
for the heck of it. True.
So I think being disciplined and having a framework is more important. In times like this, you really understand the importance of asset allocation. You really understand the importance of choosing the right funds in line with your risk appetite. You understand why a certain fund performs in a certain way. What is the investment philosophy? I think things like those, doing homework, due diligence, is most important. I believe that the next few months are, so every time a cricketer goes out to bat, he doesn't need to hit a six. Sometimes you just need to stand at the crease, understand what your competition is doing, and understand. I think we are in that sort of situation now. Do homework, take your time, think through some of these things. Sometimes you get this opportunity rarely, but now is the time to really go deep into some of these issues and understand asset allocation more importantly.
Great. Roshi, we have a question here, that what would be your advice to long-term investors in these volatile times?
So this presentation was only meant for long-term investors. And which is why I said 7 positives, 3 negatives. And I think the 7 positives will more than outshine the 3 negatives. But I'd say for long-term investors, stick to your asset allocation. Don't get worried by all the noise and volatility. Use this time to consolidate and build portfolios. You have the time to do it. Sometimes markets are moving so fast that you're just keeping pace with it. Now, when markets are consolidated, think through some of the decisions you want to make that will help you over the next 10 years. No rush, do an STP, but this is the time to do due diligence.
Great. So Roshi, thank you for a very, very enlightening session. There was a great comprehensive view on the Indian macro versus the global macro. And as we witness the gyrating interest rates and their impact leading to huge volatility in the short term in the equity markets, one tends to lose sight of the long-term potential of equity, like you said. And as Warren Buffett famously said, the true investor welcomes volatility. A wildly fluctuating market means that irrationally low prices will periodically be attached to solid businesses. And to top it up, we at Capital League believe that as long as we have a sense of progress, then volatility should be expected, should be accepted, and actually should be embraced for the possibility of making better returns.
Very rightly said, Raju.
So thanks a lot, Roshi. It was wonderful to interact with you. And I'm sure everybody got some very, very refreshing insights today. So thank you so much. And I would like to thank you all for your time this Saturday morning. Request you please to fill out the feedback form as you exit the webinar. Thank you. Bye-bye.
Thanks, pleasure. Bye-bye.